Hey guys, so in this video I'd like to talk about stock valuation methods and how to go about valuing a stock. So when it comes to valuing a stock, the most important thing to remember is that you're buying part of a company. So what you're really trying to do is come up with the value for the entire company and divide that by the number of shares that have been issued by that company. The next thing to realize about valuing stocks or valuing companies is that because companies all operate with different business models in different industries, in different countries, in different environments, it's important to realize that there is no one single way to value a company. The different business models and the different situations of different companies and different products and different levels of competition and business environments mean that you have to approach valuing companies differently. It's important to remember when you're valuing any asset or a share or a stock that ultimately the value of that asset is the cumulative shareholder equity or retained profits or total profits that that company will earn over the life of its operations or the life of that asset. So that's how you want to approach valuing any asset. It's like, how much will this asset make me over the lifetime of its operation? So in that sense, when you're trying to buy an asset like a stock or a share, what you're essentially trying to do is you're trying to buy $1 worth of assets for less than $1. That's basically the art of investing. And on the flip side, you want to be able to try and work out or be willing to sell assets you believe that are worth $1 for more than $1. Of course, the trick with investing is that no one really knows the future for certain, and when you're trying to put a value on a company and its prospects in the future, there's always going to be some guesstimating involved or some assumptions being made, so it's not a perfect science. And really, when you're investing, what you're trying to do is make probabilistic bets on what you think the future prospects of that company are, or that industry, or those products of that company. Various valuation methods give people a little bit more confidence about whether they're buying a value at a reasonable price or at a fundamental value that gives them a good probability of making a return on that investment over the lifetime of that asset. So some of the popular stock valuation methods that get used by a lot of retail investors and some institutional investors are things like so a general rule of thumb might be that a company is undervalued when it trades below 15 times earnings. That's a general rule of thumb, and that's not what I would advise to anyone, but that is, I guess, one of the valuations methods that some people use. Another valuation method is the price-to-book ratio. So in the sense that you look at the net assets of a company or the book value of the company, so sort of like the shareholder equity within that company, and this would require having a look at a company's balance sheet. So sometimes there might be $2 worth of assets per share, but the company's only trading for $1. So in that sense, you might be buying $2 worth of assets for $1. And so you can sit there and go, well, if the company has correctly valued those assets, it could sell off all those assets to the market for $2 and then give all those profits back to shareholders. So price to book is one that people look at, but again, that is a lot more technical than that. There's a little bit to it, and I'll have to address that in a separate video. Like all of these valuation methods, they have positives and negatives, and there are good times and poor times to use them depending on the business model, the environment. Another valuation method that is often looked at is price-to-sales ratio, which is essentially, again, looking at the stock price versus how much revenue that company generates per share. Another one that a lot of people like to use when looking at growth stocks, companies that are growing, is a PEG ratio, So that's sort of using a P ratio but adjusting it for the rate of growth that the company's experiencing. In the sense that you tend to be willing to pay a higher price or a higher multiple of earnings if you believe that that company is going to grow further in the future. So if it grows 10% a year over the next 5 years, obviously the company is going to be substantially larger in 5 years' time than it would be a company that is only growing at 2%. So therefore you wouldn't want to pay, or you may be willing to pay more or a higher multiple of earnings to own that company. This valuation method is one that I like to look at a little bit more. It's because it takes into account the net debt of a company in the sense that enterprise value is like the amount of money it would cost to buy out the entire company and pay off all its debt. So because debt is real in the sense that if a company has $1 million in equity and $1 million loan from the bank, if you wanted to buy out that company unencumbered, you'd have to pay $2 million, $1 million to the existing shareholders and $1 million to the bank. And using EBITDA in a valuation method gives a different perspective on the earnings of a company as well, in the sense that EBITDA represents earnings before interest, tax, depreciation, and amortization, which is sort of like looking at the cash flows of a company before adjustments start getting made for things that may be different between different companies. So different companies might have different depreciation rates or pay different taxes or have different levels of debt and therefore have more or less interest. So looking at things from an EBITDA perspective can offer a different view and potentially give you a more accurate overall picture of that company's financial situation. Another common one that people like to look at is dividend yield. So that's essentially the price of the stock divided, the dividend paid per share divided by the stock price. So a lot of people look at stocks as investments that should generate cash flow and throw off income to allow people to spend on lifestyle expenditures. And so dividend yield can be a popular valuation method that a lot of people who like those regular cash flows, they'll look at that a little bit more. And that can vary between companies, but some growth companies may not want to be paying out lots of dividends because they like to reinvest those profits into growing the company, whereas other companies that are very mature might have much higher dividend payouts because they don't have the same opportunities to reinvest those dividends. And then you can get other valuation methods like discounted free cash flow or doing net present values on assets of companies. And so there are quite a few different ways you can look at how to value a company, and none of them are the right way all the time. Every company is a little bit different, and I'll create up a bunch of videos to explain the advantages and disadvantages of the different valuation methods. You want to pick and choose different methods at different times, or use multiple methods to try and make sure that the investments you're making are as secure as possible or offer the best probabilistic potential for return. So you've got to look at every company differently, and remember that at the end of the day, you're trying to buy $1 for less than $1. That's the game of investing. So I'll leave it at that for this video. If you've enjoyed this video and you want to see more videos like this, or review the various valuation methods that are coming out, be sure to like this video, comment, subscribe, and share it with people that you think may get some value out of it. Thanks again, I'll see you in the next video.